Good day, fellow investors. In this video we're going to discuss Berkshire Hathaway, its 500 billion market capitalization, and compare it to the sum of parts value, which is significantly higher than what the market is valuing Berkshire now. I have recently analyzed all railroad stocks, and I have done a video on that, so you can check that. And in that analysis I said, okay, which is another class 1 railroad? That's Burlington Northern Santa Fe that Warren Buffett purchased in 2009. And then I went to the through the financial statements, and two things struck me. First, the lower debt that Burlington Northern has compared to all other railroads, and that the market value of Burlington, with a free cash flow yield of 3% that most other railroads have, would be 200 billion. That would make 40% of Berkshire's market capitalization. Just the one railroad that makes 1/6 of profits. That's unlogical, that's a market irrationality, and that's what we're going to discuss in this video. By analyzing all the holdings of Berkshire's part by part, seeing what would be a market valuation given the average market valuations, pricings, and then give a sum of parts valuation of Berkshire, that puts another perspective on the undervaluation, the quality that Berkshire is. By the way, disclaimer, I am long Berkshire, I love Buffett, so that might be a bias on my side, but let's start with the analysis. So this is what I have done. I have compared everything in the railroad sector, and this goes even to 2.6%, 7 now, but average debt to cash flows are 6 for the listed railroads. Debt to cash flows for Burlington Northern Santa Fe, I first thought it was 0, but they have some debt in the structure there, so 3.5 times debt to cash flows. And if I would put it on a 3% cash flow yield that's average for other railroad stocks, the market cap would be 198 billion on the 5.9 billion free cash flows. And this is extremely significant because I was just listening to Nassim Taleb's recent Bloomberg interview. I'll make a summary and a discussion on that on Friday, so please subscribe because it's very interesting. But what was very interesting was Nassim's coherency in thoughts with Warren Buffett. When Nassim was a trader, the saying was, take all the risks you can, but make sure that you are there tomorrow. So take all the risks, but keep alive, stay in business. And that's exactly what Warren Buffett is doing with his railroads. No matter what happens, given the lower debt than other railroads, Buffett is pretty sure that his railroad will survive whatever comes at it. All the other railroads are forcing buybacks, lowering their cash flows to the minimum amount and increasing debt higher and higher. The same was done by airlines, for example. And that's something that shows really, okay, Buffett way of thinking, value long-term, slow and steady versus the market. And Buffett's idea is now undervalued, and that's peculiar or not. That's the standard, but Buffett is on the top 5 richest persons in the world. Everything else is mambo jumbo. And then again, something that Nassim said, nobody's bigger than the market. The railroads have very strong buybacks, spending on buybacks more money than what they make, and yes, railroad stocks have outperformed the S&P 500 over the last 5 years, over the last 10 years. Berkshire, I don't think, did that over the last 10 years, but remember, nobody's bigger than the market, so sooner or later, if you do financial engineering to beat the market, it's unlikely you will do that for longer. So railroad investors, get out and buy Berkshire. And here is the sum of parts valuation. We'll go through each one, try to keep in mind the score over time, and then at the end of the video I'll show you the right value, and then you'll see how the market is wrong, and you'll see whether you will be wrong too, because it's a lot to keep in mind each segment, each part of Berkshire, and the correct valuation. Let's start with this game, and let me know in the comments if you got it right at the end. So, we already mentioned Burlington Northern Santa Fe earnings 5.4 billion in 2019. I'm going to use 2019 as a benchmark year because I think COVID will pass sooner or later, so all businesses will return to normal and will grow alongside the American economy in the future. I have looked at the statements of Burlington Northern, and I see that they have paid out almost 6 billion, which I'll consider free cash flows. They made 9.7 billion in operating cash flows, had 3.6 billion of capital expenditures, and what's left has been paid out to Berkshire. So let's say 6 billion free cash flow. They have some debt, 23 billion, okay, with the 4.6% interest rate, still lower than other companies. And when we compare it to others, to the free cash flow yield, I have corrected this. Canadian Pacific is actually 2.4, so even lower. 3% free cash flow yield, 6 billion, 200 billion market valuation. Plus, it's easy to borrow more, plus it is a financial fortress. So if any of these guys gets in trouble, Burlington will be the one buying their assets. Very interesting, typical Buffett style. After railroads, a business that Buffett loves really much is Berkshire Hathaway Energy. And the earnings there have been 2 billion, then grow, and now they are 2.8 billion for 2019. The earnings there are growing at 10% per year because Buffett is reinvesting all the earnings. This is very important, keep it in mind, you'll see later the comparison. Reinvesting all the earnings for growth, and all the earnings growth is based on that equity reinvestment where Berkshire Hathaway Energy doesn't pay dividends to Berkshire. And that's the key, slow growth for Berkshire Hathaway Energy, but still growth, which is much better than other companies. We'll see in a moment. On a note on Berkshire Hathaway Energy, so a lot of investments in solar, wind, growth, Mid-American. So really good company, like most others Berkshire Hathaway companies, and their vision is typical Buffett for the next 100 years of providing energy. The debt to assets, if we look at the balance sheet, is just 25%. The profits, 2.8 billion, approximately 10% on the shareholders' equity there, 2.8 billion on 29 billion shareholders' equity, likely grow also over the years, slow and steady, and the management has said that they have investment opportunities for 8, 9%, 10% returns on equity invested. This is what Buffett does, and really remember this debt to assets ratio of 25%. If I compare this to other energy companies, the top 5 in the energy US ETF, then we can see that the debt to assets ratios is insane for Berkshire Hathaway Energy. So really low, and everybody else has huge debt to assets ratios. So liabilities, and we know how liabilities backfire. If I look at net income, Berkshire is somewhere there. It's not that these guys are much better, and on the growth, just NextEra Energy has 10% growth, and we'll discuss that also in a moment, alongside similarly as Berkshire Hathaway Energy. If I compare the market capitalizations depending on the price-earnings ratio, but if I take a 25 price-earnings ratio for Berkshire Hathaway Energy, which should be the average, it has growth, it has much less risk, much less debt, so the market capitalization is 70 billion if it would be a public company not owned under the Berkshire umbrella. Talking about NextEra Energy, this is the NextEra stock chart, this is the Enron energy company's stock chart from the 1990s. Any similarities? Well, I'm not saying there is fraud with NextEra. I'm just saying something that also Nassim Taleb has just explained. There is no growth based on debt. So NextEra has the same growth rate as Berkshire Hathaway Energy, but Berkshire Hathaway Energy, typical Buffett style, doesn't grow on debt. And another thing that Buffett agrees with Nassim Taleb, there is no growth based on debt. If you grow on debt, it's no growth. Very important to note. Let's compare really NextEra and Berkshire Hathaway, completely opposite. As I said, really low debt for Berkshire Hathaway Energy, 8.5 billion lowered even. They keep the equity invested and grow on debt. But if I compare it to NextEra Energy, their profits over 2019 were 2.5 billion. Their assets over the year at the end of 2018 grew 15 billion. So Berkshire grows on the assets, on the earnings they make, that's it. No more debt, no risk, slow and steady. NextEra has earnings of 2.5 billion and they managed to grow at 15 billion. If this ends up another Enron, Berkshire Hathaway will have a lot more of buying to do, and this is perhaps the reason why Buffett has such a huge cash pile. That's also part of the valuation that we'll discuss later, and he's just waiting for all of those houses of cards out there. You grow assets in 7 times more than what is your net earnings, and that's something that works until it doesn't. When it stops working, Buffett comes in and Buffett starts buying, like he did in 2009 with Burlington Northern, banks and whatever. That's Warren Buffett. His business is set up to work forever. Most other businesses in corporate America are set up to push the stock price higher until it goes, until the party goes. And that's something to keep in mind also when valuing Berkshire Hathaway. The market doesn't like it. The market wants stocks to go higher. You want stocks to go higher. Berkshire is not a stock that's pushed higher, therefore it's valuable, therefore it's undervalued, and therefore it makes a better investment than 98% of other corporate America. And even Nassim Taleb agrees with all the fundamentals of Warren Buffett, which we'll discuss in next video, so please subscribe to this channel. This is where you get the long-term value. So on a valuation, 70 billion to Berkshire Hathaway Energy. Then we have all the manufacturing, service and retailing businesses. We have Clayton Homes, Duracell, Precision Cast Parts, a lot of businesses, Nebraska Furniture Mart. So all these businesses make 9.3 billion in earnings. If I attach a price-earnings ratio of 20, which should be okay for these businesses, it's a diversification on America practically, price-earnings ratio of 20, I think it's fair. So the valuation 180 billion for all the manufacturing businesses out there of Berkshire. Then we have insurance, and Berkshire Hathaway is one of the biggest insurers out there, and this valuation might surprise you. Because insurance, the underwriting part, the focus is not on making profit, and Buffett says yes, they have made 28 billion in profits over the last 15 years, but that's not the goal. The goal is to create the float, therefore it's worth to sacrifice the profits. Over the last years it was just a break even, so let's not calculate this as value. Let's just calculate the value in the stock market portfolio, which is under the insurance arm, and therefore put a low valuation on the insurance. If we look at MetLife's Prudential, it's what, 24 billion market cap, MetLife 33 billion, so not something crazy there. I'm going to put, let's say, a valuation of 25 billion on the insurance part because the value is in the float in the stocks. And the value of the stock market portfolio, that's very easy. We have here CNBC with the Berkshire Stock Market Portfolio Tracker, 227 billion, 597 million, so very easy to value. Remember, 227 billion. Sorry. And this is very interesting. If you go to Berkshire's annual letter to shareholders, you see that they don't see that as stock prices going up and down. They see the stock holdings as an agglomeration of businesses that have a 20% return on equity. And that's what they are focused on. They are business owners, not business traders, not stock market traders. And that's always the main message with Buffett. And that's why I also think he has immense value. Because those businesses giving 20% return on equity invested, and therefore it's likely that they're going to compound for the very, very long term, but the market, 227 billion, let's take that as a value. Then another discussion on cash. These are the assets, and on that balance sheet you have 137 billion in, let's say, cash or cash equivalents. If I deduct all the liabilities for the potential insurance liabilities, total 87 billion in debt, 65 billion in tax liabilities, I get to equity of 428 billion. Deduct the stock market valuation that we already calculated, I'm down to 180 billion. Other liabilities potential, we can assume that the 143 billion in cash there can be considered as value because Buffett can do whatever he wants with that, even pay a dividend. Yes, I said it. Sorry, Buffett, I know you don't want to do that, but I said it. So the total market valuation perspective on Berkshire Hathaway would be $845 billion. Compare that to the market valuation current of 514 billion and you see a huge discrepancy. Why do you see a discrepancy? Because Warren Buffett isn't crazy about getting leverage to do buybacks. Like most of corporate America, that pushes stock prices higher, higher and higher, higher valuations. Buffett doesn't do it. Buffett's stock will not go crazy up like many others can go, therefore there is not so much interest. But investing is about the long term. What is your horizon? 10, 20, 30 years? Can you sell? If a company is doing buybacks, to take advantage of that, you have to sell at some point. The buyback party will end at some point and then you have to be out. How long it will last, we don't know. Buffett is not playing that game. Buffett is playing the business game that will surely be there over the next 10, 20 years, and the market is actually punishing him because of that. As would Buffett say, price is what you pay, value is what you get. In this case with Berkshire, if you pay the price of 514 billion, you get more value than what you are actually paying, because Berkshire is Berkshire. And the question is, what kind of assets do you want in your portfolio? What kind of businesses? What kind of investing mindset? You want a long-term investing mindset that is a financial fortress, that renounces taking leverage to chase returns, to look like next era energy, but you want safety, you want certainty that in 20 years they will be a little bit bigger, as others don't know where next era energy will go bankrupt or not. But when some of those playing that game goes bankrupt, Warren Buffett comes in with 9% convertible notes to help them. That's the kind of strategy you have to see and see what fits your portfolio. So please subscribe if you enjoyed this analysis. On Friday we'll discuss a more economical discussion with Nassim Taleb's view on the economy, the main investment risks, how he fits with Warren Buffett, how his thoughts and fit what Warren Buffett is actually doing. Very, very surprising. As I said, I'm long a little bit on Berkshire, I always watch it, I cover it on my stock market research platform, and this is always, I like to see, it's always good to keep the right mindset, and you get that by just looking at what Warren Buffett is doing, is still doing, has been doing for the last 70 years, and that has actually worked for the last 70 years. If you want to check anything that I do, please check everything in the links below, from my Modern Value Investing book to my research where I analyze different companies, commodities, emerging markets, etc. And if you're interested in that, you might find some value. Thank you for subscribing. We are reaching almost 100,000 hopefully soon. Thank you for that. I'm looking forward to your comments, and I'll see you in the next video on Friday.